Two Canadians in Hamilton, both 58, both sitting on exactly $600,000 in a registered retirement savings plan, both walking out of the same plant at 60 with the same pension behind them. 14 years later, one of them has paid $46,640 more tax than the other on the same money, and lost part of their old age security on top of it. Neither of them picked a better fund, neither of them earned a better return, and neither of them did anything their bank would have called a mistake. What separated them was a date. The year one of them stopped feeding the RRSP and started filling a tax-free savings account instead. That date exists for you too. It is already sitting on your calendar, and there are 5 signals that tell you where. The 5th one is the one that should bother you, because it doesn't show up until after you're gone. Call them Gary and Wendy, and by the end of this, you'll know which one you're currently being. Start with the thing nobody says out loud in a branch. The retirement plan is not a tax break, it's a bar tab. You skip paying today, the bill goes on the tab, and the Canada Revenue Agency decides which year to close it out and what rate to charge you when they do. If your rate today is higher than your rate then, you win, and that's a real win. If it's the same or lower, you carried that money for 30 years so somebody else could collect more of it at the end. That's the entire product. Everything past it is a pamphlet in a lobby, which makes the switch into the tax-free account arithmetic rather than preference, and it runs on 2 numbers. Number 1 is the rate you're paying on your last dollar right now. Number 2 is the rate you'll pay on your last dollar at 72, and almost nobody has worked that one out, because everybody assumes retirement automatically means a lower bracket. For a lot of Canadians, it doesn't. There's also a specific date where your control over that second number ends entirely, and we'll get to it in about 6 minutes. 5 signals. Any one of them means your switch date is here or already behind you. Signal 1. Your income peaked and went flat. The deduction is worth your marginal rate and not a cent more. In Ontario for the 2026 tax year, income up to $53,891 carries a combined marginal rate of 19.05%, and from $58,523 to $94,907, you're at 29.65%. So Gary puts $10,000 into the RRSP at 29.65% and gets $2,960 back, while a neighbor doing the identical thing at 19.05% gets $1,905, which means the same contribution bought 2/3 of the benefit. Gary spent his 40s in the higher bracket, which is exactly when that account earns its keep, then spent his 50s watching his income level off while he kept contributing on autopilot, buying a cheaper deduction every year against a balance that keeps getting taxed later. If your income flattened and the account is already substantial, it did its job. That isn't a mistake, it's a graduation, and the next dollar simply belongs somewhere else. Signal 2. You have a defined benefit pension. This one catches teachers, nurses, municipal staff, and a good chunk of the retired manufacturing workforce in southern Ontario. A defined benefit pension arrives every month whether you wanted it that month or not, and the Canada Pension Plan and Old Age Security arrive right behind it, so by the time the money in your retirement plan pulls in, the low brackets are full. It circles the lot and parks in the expensive spots. You didn't defer into a lower rate, you deferred sideways, and paid a management fee for the years in between. Signal 3, and this is the one that genuinely gets me, is that you earn under roughly $50,000 and your retirement will include the guaranteed income supplement. The supplement is income tested, so for a single senior the cutoff sits around $22,512 of income other than old age security, and every dollar above the floor claws back roughly 50 cents of it. Withdrawals from a retirement plan count as income for that test. Withdrawals from a tax-free savings account are invisible to it, and that invisibility is the whole reason this switch exists. Picture Marlene, 63, 30 years of part-time hours with a school board, $48,000 in a retirement plan a teller told her to open in 1997. Her deductions were worth about 20 cents on the dollar. At 68, she takes $6,000 out for a furnace, pays $1,143 in tax, and then Service Canada quietly trims her supplement by roughly $3,000, so that withdrawal cost her about 69 cents on the dollar. On a woman with a paid-off bungalow and a 9-year-old Corolla in the driveway. If that's you, or your mother, the money isn't stranded, and the fix is in the second half of this video. Signal 4. Your balance is large enough that the decision gets taken away from you, and this is the date I promised. By December 31 of the year you turn 71, that account has to become a registered retirement income fund, an annuity, or cash. Miss it, and the whole balance is deregistered and taxed in 1 year, which is a bad Tuesday. Once it's a RRIF, Ottawa installs a tap on it, and every year you must withdraw a set percentage of the January 1 balance, and every year the tap opens a little wider. At 71, the factor is 5.28%. At 72, it's 5. 40%. At 75, it's 5.82%. At 80, it's 6.82%. At 85, it's 8.51%. At 90, it's 11.92%. And from 95 on, it's a flat 20%. Run Gary's $600,000 through that. In the first year he's required to take anything, the tap pulls $32,400 out whether he needs a dollar of it or not. And Old Age Security adds another $9,023. 64. Since the maximum payment for the July to September 2026 quarter is $751.97 a month from 65 to 74, and $827.17 from 75 on. That's $41,423.64 before his Canada pension plan has even landed, and his workplace pension pushes him into 29.65% permanently. And in April of 2025, the government promised to cut those minimums by 25%. That October, a Department of Finance spokesperson said the reduction was no longer required because markets had recovered, and Budget 2025 arrived in November without it, which is a useful lesson about building a retirement around an announcement instead of a rate table. Signal 5. You're single, widowed, or there's no spouse to roll the account to. Hold that one. It's the most expensive item on the list, and it stays quiet until the last section. There's one more threshold sitting above Gary, and it's the one people already fear by name. The Old Age Security Recovery Tax, the clawback. For the 2026 income year, once your net income passes $95,323, Ottawa takes back 15 cents of that pension for every dollar above the line, and it stacks on top of your regular rate, so someone paying 31.48% who trips it is effectively handing over more than 46 cents on the dollar. That's the last piece of theory in this video. If this is useful, subscribe. I do Canadian retirement math every week, in plain numbers, with nothing to sell you. Now, before the solution, one number decides whether you should even be worried. So let's get it on the table. The median Canadian aged 55 to 64 has $100,000 in registered retirement savings. That's the midpoint, so half the country sits below it. The average tax-free savings account held $33,534 in the 2023 tax year, and only 8.55% of holders had used up their lifetime room. Two things follow. If you're sitting on a large retirement plan, you are nowhere near behind. You have a good problem with a deadline attached. And if you're nowhere near Gary's balance, you have enormous unused room in the tax-free account and a far simpler decision than his. For what it's worth, more Canadians now put money into the tax-free account than into the retirement plan. 7,520,350 filers against 6,350. 070 in the 2023 tax year, so the country is drifting toward the right answer without ever being told why. Now, Wendy. Between the year you stop working and the year you turn 71, there's a stretch where your taxable income can be lower than it will ever be again, with no employment income, maybe no Canada pension plan yet if you've deferred it, maybe no old age security either. A quiet gap where you're holding the dial instead of Ottawa. Advisors call it an RRSP meltdown. It's blunt, it works, and there's exactly one thing that can break it, which I'll come back to before the end. Wendy retired at 60 and, instead of leaving the account alone, deliberately pulled about $40,000 a year out of it for 11 years, roughly $440,000 in total, taxed almost entirely at 19.05%. What was left after tax went straight into the tax-free account, where it will never be taxed again and never counts against a single benefit. Gary's $440,000 comes out later on the TAP schedule at 29.65%. That gap is 10.6 percentage points on $440,000, which is $46,640, the number from the first line of this video. 3 mechanics matter when you actually run this. First, fill the bracket, don't spill it. Take your projected taxable income for the year, find the top of your current bracket, and withdraw up to the line, which in Ontario means $53,891 before the rate steps. Going over doesn't re-tax everything underneath it, but there's no prize for volunteering. Second, understand the withholding. On a single withdrawal outside Quebec, the institution holds back 10% up to $5,000, 20% from there to $15,000, and 30% above $15,000, while Quebec applies lower federal rates plus its own provincial withholding. That money isn't gone, it's a deposit against your return rather than the final price, but a series of smaller withdrawals keeps more cash in your hands during the year. Third, the receiving side has to be ready. The tax-free savings account limit for the 2026 tax year is $7,000. And if you were 18 or older in 2009 and never contributed, your cumulative room is $109,000. When you withdraw, that room comes back on January 1 of the following year, not the following week. So putting it back early with no room available costs you 1% per month on the excess. 2 smaller moves right along, and they're free. You don't have to wait for 71 to convert, because turning a slice of the RRSP into a RRIF at 65 creates eligible pension income, which qualifies you for the pension income amount on line 30, $1,400, a federal credit on up to $2,000. Watch the age rule though. A RRIF withdrawal counts at 65 and older, while a lump sum straight out of the retirement plan never counts, and neither does the Canada Pension Plan or Old Age Security. The other is pension income splitting. From 65, you can move up to 50% of eligible pension income to a spouse using Form T-1032, elected fresh every year, and because the recovery tax is assessed on individual net income, shifting income to the lower earner can pull the higher earner back under that $95. 323 line, while both of you claim the $2,000 credit instead of one. Which brings us to Signal 5, and the 10-minute job I mentioned. When you die, unless the account rolls to a spouse or a financially dependent child, the whole balance of the retirement plan or RRIF is reported as income on your final return. Not the growth, the whole balance, in 1 year. Gary is widowed at 78, with $520,000 still in the RRIF, and that balance lands on a single tax return in Ontario, where almost none of it is taxed at a low rate, and every dollar past $258,482 is taxed at 53.53%. The tax agency was the silent beneficiary on that account the entire time, and nobody ever printed the name on the statement. Wendy dies the same year with $300,000 in the tax-free account, and her successor holder takes it over intact, tax-free, with no effect on their own contribution room. Same plant, same pension, same bungalow, different form signed at a desk in their 60s. That form takes 10 minutes, and it's worth more than any fund you'll pick this year. Now the honest other side, because a strategy that fits everyone fits nobody. If you're still working and your last dollar is taxed at 43.41%, which in Ontario starts once you pass $117,045, keep contributing to the RRSP and put the refund into the tax-free account. A deduction at 43.41% that you unwind later at 19.05% is one of the best deals in the tax code. The rule never changes, only your rate does. And the thing that breaks the meltdown, as promised, is an early death. If one spouse dies at 68 instead of 88, the survivor loses a Canada Pension Plan check and an old age security check, files as a single taxpayer, and may want back the RRIF balance you spent a decade draining. That's real, and it's worth an hour with a planner who can see your whole picture rather than a rule of thumb from a stranger on the internet. So here's the sequence. Find your marginal rate today. Then, estimate your rate at 72 with a Canada Pension Plan, old age security, any workplace pension, and a RRIF minimum all landing in the same year. If today's number is higher, keep contributing and shelter the refund. If it's equal or lower, your switch date has passed, and every further dollar belongs in the tax-free account. If you retire before 71, drain the retirement plan deliberately through the quiet years and refill the tax-free side with what's left. Then check your successor holder designation, because that's the 10 minutes. This is general information for Canadians rather than advice about your situation, and every benefit threshold and contribution limit in this video resets each year. One of them read a rate table. The bill was always coming for both of them, and the only thing either of them ever got to choose was the year it arrived. Pull out your notice of assessment this week and find out which one you are.